Deciding between a Roth and a traditional retirement account dictates how much of your life savings you actually get to keep. Yet most people make this choice based on a guess. The standard financial advice usually stops at a simple phrase. With a traditional account, you pay tax later. With a Roth, you pay tax now. That phrase sounds nice, but it completely fails to answer the only question that matters for building wealth. Which account leaves more net cash in your pocket when you actually retire? This is not about your personal timeline preference. It is a strict mathematical equation driven by two variables, your marginal tax rate and the size of the base that rate is applied to. Look at this section of the standard IRS 1040 form. We're going to run the exact math using the actual 2026 federal tax brackets and a realistic 7% average annual growth rate to see exactly how this works. Relying on catchy rules of thumb instead of running these numbers often costs U.S. savers tens of thousands of dollars in unnecessary lifetime taxes. Consider a 30-year-old making a $70,000 salary. That income puts them in the 22% marginal tax bracket, and they have $7,500 ready to invest. On the Roth path, they owe taxes today. A 22% rate means paying $1,650 upfront. The remainder compounds over 30 years at 7%, growing to $57,092. Having paid the initial toll, every dollar is legally theirs tax-free. The traditional path grows untouched to the identical $57,092 balance, but in retirement, the IRS collects. Taxing this compounded balance even at a lower 12% rate costs $6,851. Comparing final numbers, the Roth wins by nearly $7,000. The traditional path applied a smaller tax rate, but applied it to a massive final balance. The Roth path applied a higher tax rate, but on a tiny initial contribution. The rate matters, but the base you apply it to dictates the outcome. But the Roth does not always win. Let's look at a scenario where your marginal tax rate in retirement stays exactly the same as your working years, 22% now and 22% later. On the traditional path, you defer taxes up front, let a pre-tax contribution compound over decades, and then take a 22% tax cut from the massive final balance. On the Roth path, paying that 22% up front leaves a smaller initial principal to compound over time, but you keep all of the final growth. This matrix compares the exact outcomes. If tax brackets remain equal, both paths yield an identical $42,334. Dropping to a 12% retirement bracket makes the traditional path wealthier. Conversely, jumping to 32% makes the Roth severely outperform. If your tax bracket stays constant, the financial superiority of either account disappears entirely. The decision between these two accounts reduces to one specific forecast, predicting whether your marginal tax rate will be higher or lower on the day you retire than it is today. Peak earning professionals currently in the top brackets, like 32% or higher, logically lean toward traditional accounts to slash their high immediate tax liability. By maximizing their capital retention today, they accept the trade-off of a heavy tax burden later, particularly when required minimum distributions force withdrawals at age 73. On the flip side, young savers in the 12 or 22% brackets can use the Roth to lock in a lifetime of tax-free growth at a steep discount. Of course, your personal income is only half the equation. The other half is Congress. The entire federal tax code could be rewritten multiple times before you retire. Because no one can accurately predict future legislative changes or exact future income, putting all your savings into a single tax treatment leaves your wealth fully exposed to tax rate hikes. So, how do you plan for retirement when you cannot perfectly predict your future tax bracket? You utilize a strategy called tax diversification. This flowchart illustrates the approach. Instead of choosing one path, you fund both, a traditional 401k for the immediate deduction and a Roth IRA. In retirement, both buckets give you total control. Toggle between pre-tax and post-tax withdrawals yearly, actively managing your tax rate. The Roth bucket is particularly valuable here. Because it has no required minimum distributions, you can hold it in reserve for large expenses without fear of being pushed into a higher tax bracket. Optimizing your retirement means balancing both tax paths today. It gives you the necessary flexibility to adapt your withdrawals to whatever economic conditions the future holds. Mastering the math behind these accounts shifts you from passively guessing about the future to actively controlling your financial outcome.